Joining us, Ann Sonders is the Chief Investment Strategist at Charles Schwab. Good morning, Ann. Great to have you.
Good morning, Oliver. Nice to see you.
So we've had quite a roller coaster week. Take me through where you think we're at, because it seems to me this question of rotation kind of still up for grabs, what it means for the index.
It is still up for grabs. I think a lot of it is predicated not just on better inflation data, which we saw in the immediate aftermath of the CPI report, but expectations around Fed policy. That said, even though I think there continue to be opportunities kind of outside of the Magnificent Seven down the cap spectrum, I don't think we're going to continue to see the kind of outperformance we've seen over the past week or so. In fact, we're not even, the market hasn't even opened yet, but pre-market would suggest there's maybe a little bit of some near-term exhaustion in some of the small cap trades. And one thing we've been saying is, even though there was a broad rally within an index like the Russell 2000, including the non-profitable stocks, the zombie stocks, I think you want to fade that part of the rally and lean into the higher quality segments within an index like that. So stay with profitability, stay with high interest coverage. I think that's the way to approach this unique period of time where we're trying to assess whether this rotation has long-term legs.
It's a nice kind of return to a wider breadth, as we see in the chart here, with the number of companies above the short-term moving average. But to your point, and what I've been saying is that the math, the tech math is not super hard to figure out. You know which sector is the most important for the market. It doesn't have to be that way, but until it changes, that's kind of our guiding light is technology, but more kind of specifically those top 7 companies.
Yeah, I think earnings season is going to be important. Maybe that's the ultimate statement. Earnings season is always important. But I think because the consensus expectation is that by either the third or fourth quarter, we will have seen almost full convergence in terms of earnings growth for the Magnificent Seven relative to the rest of the market. And even though reporting season is for the second quarter, we'll obviously get outlooks for companies. And I think getting a sense of whether that convergence and the expectations of a full convergence is accurate, I think will set the landscape for the second half of the year, especially from a valuation perspective, because leaving aside the last week in the aftermath of the CPI report, there was much more price appreciation in groups like the Magnificent Seven than there was an increase in forward earnings expectations. But on the other side, you also have a pretty significant plunge in forward 12-month earnings expectations for the Russell 2000. So it is, for a lot of reasons, a bit of a show me quarter, not so much for second quarter, but the outlooks for the second half of the year.
Really important, because even though all this started with CPI, pinpointing causality in markets is always kind of a gray area. And I do wonder, in the back of my mind, Lizanne, to your point about valuations in big tech, even if this kind of were spurred on by that CPI drop, does it also suggest maybe some of it came from investors ready to take profits in tech, a category of that Mag 7 group that maybe just got too expensive relative to earnings?
Yeah, I think there's a lot of itchiness, both on the desire to trim some of the mega cap leaders, especially given those forward earnings estimates not maybe being supportive of the price appreciation that we saw. And also, as we have seen, a lot of money itching to find opportunities outside that space. And you saw it not just at the index level of a shift from areas like the S&P and the NASDAQ to indexes like the Russell 2000, but obviously in terms of sector rotation as well, with sectors and sub-industries that had been significant laggards getting a bit of a lift. Now, some of that is short covering. I always think, well, so what? Stocks are going up, whatever the reason. But I think short covering in terms of the rotation has been a factor as well, especially at the sector and industry level.
Adding on a little extreme kind of nature when folks are squeezed and kind of trying to run to and grasp to get more in line with kind of, I guess, a more diversified look at the market. How much of the data economically, Lizanne, do support what has generally been a more cyclical leadership in the past week with this rotation?
That's the big question, because with the reports that we got out today, particularly on initial unemployment claims and continuing claims, that may be perfectly supportive of what the market has honed in on, which is a September start to rate cuts, but it may call into question the ability for the economy to continue to grow robustly enough that it's supportive from a valuation perspective and supportive just in terms of the earnings growth profile, especially in the more cyclical areas and down the cap spectrum, which those are inherently more cyclical type companies. So I think we're in a tricky spot right now because the combination of the Fed's dual mandate, the inflation data and the labor market data, is supportive of a cut, but more significant deterioration, particularly in the labor market, starts to elevate concerns about an actual NBER declared recession. And then you really have to reassess what that means from a forward-looking corporate earnings perspective.
Now, the momentum of the weakness in data seems to have abated a bit, though. Like the retail sales number pretty good. A few things here that beat expectations, or at least stopped missing as terribly as we were a couple weeks ago. I guess kind of helps us envision a future where maybe we cut and it's not to have to rescue a crashing economy.
Right. Yeah, you're right. I mean, retail sales were a little bit stronger than expected. They weren't strong in an absolute sense, just better than expected. Industrial production came in better than expected, but then you had the weaker claims data. So, yet again, here we are with conflicting economic messages coming from the data points. And I think the labor market, though, outside of obviously inflation, is what holds the key for the Fed, but to get a clear picture for the broader economy, you've got to look at everything. And it was the case that in the aftermath of retail sales, and then with some of the updated estimates for private inventories, you did see Atlanta Fed's GDP now for Q2 pop up to 2.7%. So certainly nothing scary at this point, but I think on a going forward basis, I think the labor market holds the key both to the trajectory of the economy, especially the consumer, and obviously Fed policy.
Okay. And we're looking at those GDP estimates from Atlanta Fed, a little tick up there to the point of this patch of strength. When it comes to catalysts for the market, Lizanne, Fed commentary at this point, when the market is really, really locked in to 3 cuts post-September, how much do you think the Fed commentary impacts what happens here on a daily basis?
Well, arguably it already has. I mean, the Fed has been pretty clear that in their mind, the next move is a cut, and that is the path of least resistance, and that's their desire. So the telegraphing essentially of that without precision around timing did help to loosen conditions a bit and gave fillip to asset markets, not least being the stock market and down the cap spectrum, obviously. So that's both, I guess, an opportunity in terms of getting a clearer sense of what the Fed plans to do, but maybe a curse in the sense that there's already been some loosening of conditions in light of just what they have very subtly tried to telegraph. So I still think that although the market is honing in on September, the Fed doesn't tend to buck what the consensus is. If we were to see another tick higher in inflation or much stronger growth coming through in terms of economic data, that the Fed might say, hey, it's not 100% clear that we're moving in September. So I'm not sure we should be sort of putting all the eggs yet in the September basket.
Amazing. After everything we've been through, we still do the give a mouse a cookie and just running with it thing anytime the Fed gives us a morsel. Lizanne, before we let you go real quick, has there been anything in your mind that is obviously tied to election outcomes or politics in this market as some of the polls have shifted over the last week? Anything in your research that makes it obvious or clear?
I wouldn't say it's obvious if you wanted to solely point to the prospects of what happens in the election to what the market is doing, because you've had momentum in that direction. And I think the big rotation that might have been tied to poll results or the assassination attempt, I think has probably more to do with what we already talked about, the positive reaction to the inflation data, the move down in yields, and the sort of at this point cementing of the idea that September is the start point. So I think that has been more of a force behind what is going on within markets than election-related potential outcomes.
Yeah, great stuff. Agreed. Thanks, Ann Sonders. Fantastic conversation. I think we got it all. Appreciate it.
Thanks.
Chief Investment Strategist at Charles Schwab.